Good afternoon and welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do today's the same as we normally do. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those four, we'll take a quick look at the US dollar, see how it's affecting gold and silver, and see what oil is doing as well. And once we finish with commodities, we'll move on to chart requests. If anyone in here has a chart request, feel free to type it in the chat, and I'll go ahead and take a look at it when I can. Now, for those of you that are watching this on YouTube or watching a recap of this, you can always message me on Twitter at StockDarts. I'd be more than happy to give you a chart request there if you'd like. Also, obviously, you can follow me on YouTube. And if you like the content you see here, you like the way I analyze the stock market, you can visit me at patreon.com/StockDarts, where I post weekly blog content. I'll typically put up trade ideas as well as different ideas on the type of watch list or types of trades I'm going to take from week to week, depending on what my reads are during these Wednesday market reviews. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. So here's a chart of SPY. As you can see, we're red on the day, red across the board. If you follow me on Twitter, you know yesterday I put up a quick comment at the end of the day saying that this might be a good idea to start looking at some market hedges. Might be a good time to look at buying some puts or finding another way, whether it's taking profits, but another way to hedge yourself from what has been a pretty strong rally and the potential for a drop now as we continue to move forward. We're going to run into some pretty stiff resistance. I think it would be very, very optimistic to think that we could continue climbing back up towards the levels we were at before the coronavirus pandemic really started to take hold of the markets. We're still shut down across the board, and stimulus can only go so far. And once we realize that there's still a lot more to go, the market will eventually turn right back down now. The good thing is we've rallied so strongly that there's plenty of room to fall without coming back and printing new lows, which is really important. We've got plenty of cushion now once we do turn around. And as long as the market starts trading range bound, then at least it's reached a point where it's priced in exactly what it expects, and what kind of an economy it thinks we're in right now, and that would actually be a pretty good positive, right? As long as we don't continue crashing and heading to new lows, then we can start moving forward and trying to figure out exactly where we are. And I think a good part of that is going to be dependent on what we see over the next probably 3 weeks, as we go through earnings season and we start to see the earnings reports of a lot of big names. We had some banks report yesterday, and we have a retail name reporting today, Bed Bath & Beyond. And as we start to see what the retail names and some of the more important tech names report, that'll give us a much better understanding of exactly where we are right now, and what kind of damage these companies have sustained over the last quarter, and what they expect the kind of trouble they expect to have over the next quarter as they start to issue their guidance statements. And so I think we're in a pretty important couple of weeks here, and we'll see exactly what kind of tone we get out of these earnings reports and whether that's going to affect the markets positively or negatively, and if so, how strongly that will be. Now, again, as you can see, and we're going to zoom in a little bit, we've had a very nice rally off of the lows that we printed at the end of March around the 23rd, and we've had a very strong move. We've actually retraced. If we come over here and look at our fib retracement tool, and we just figure out exactly how far we've gone, right? You'll see that we've already recovered 50% of the drop that we had as we started this coronavirus pandemic, and we started to self-isolate and to quarantine. So overall, that's very positive. Now we're right at the edge again, around that 50%. But the fact that we've come back and retraced 50% is pretty impressive. Of course, whether we hold here, I doubt seriously, and I think we do come back. But now the big thing is, when we do come back, like I said, we've got plenty of room here. We can pull back now and not have to fall all the way down to new lows, right? We can come back down, and we can come down either to the 38 fib or the around the 236 fib, 23%. Now, I don't necessarily really subscribe that much to trading off of fib retracements. I just wanted to put it up here to give you guys a visual representation of how far we've come down and how far we've made up. And generally speaking, I don't look at those as targets that I'm going to look at as far as where we can fall or drop, so I'm going to get rid of them for now. But I do want to point out that, like I said, we've retraced half of the drop that we've had, and so now if we do come back and we do turn around and roll over in the markets, we've got a lot of room. We can come back and maybe retrace half of this again and make our way back down to this 240 area or the 250s, and as long as we hold above these areas down in the lower 200s, I think overall we're in a pretty good state in the market. As a matter of fact, I think ideally what we really want is for us to hold above about 255. And again, for those of you that are regulars, you'll know that we look at this plenty of times. If you look at the weekly chart of the S&P 500 and you see where we are, you see what we've done over the last 3 or 4 years now. And this area around 255 has been a pretty good floor for price action for most of the time. Now, obviously, we've had two pretty substantial slices through that, one at the end of 2018 and obviously the most recent one. But for the most part, that has held up as a pretty decent area. And it's kind of shown what kind of range we're in. And if we can kind of hold up at that area, I think that's a pretty good positive sign and shows that the market maybe is willing to stabilize and at the very least stay within sort of the state that we've been in for the last 2 or 3 years rather than turn around and start heading lower. Now again, as you can see with the S&P 500, it was kind of critical at the beginning of 2018, then became a pretty interesting point at the end, and since then we really haven't come back and tested it. So the fact that we're kind of back here could be seen as a negative, but I think if we can sustain price above it and we can get right back up here, particularly maybe back up above 260 and above our 200 weekly moving average, then that would be a pretty strong sign that the markets have at the very least adjusted to what their new state is and maybe can start looking at, like I said, at the very least trading range bound. I don't think that we're going to come back up into the 300s, particularly up near the all-time highs for a while, because we're still expecting an economy that's going to be shut down, and even when it opens up, there's going to be very limited demand for a while as the public begins to adjust to this sort of new state that it's in, and to really start to overcome some of these fears of becoming sick. So I think that there's still going to be low demand even once we open up, and that's going to cause basically a sluggish, probably a sluggish 2 or 3 quarters. Probably up to the end of the year, we're going to be pretty slow, and there's a very, very strong possibility of heading not just into a recession, but possibly even a depression. And so we have to understand that the market is going to be slower, and eventually the market's going to really pinpoint exactly what it expects out of these companies, and that's when we're going to find our point of equilibrium and where we should be trading. And I think for now the market's exploring, trying to figure out what it wants to do. It found out where buyers are willing to step in, and right now it's actually turning around and it's exploring to figure out exactly where the sellers are waiting to kind of turn this around, or more importantly, where the buyers are going to lose confidence and think that they've gotten enough back out of this. Personally, for the last month or so, I've been kind of doing the opposite of what the market's doing. If the market's going down, I was looking at buying, and if the market's going up, I'm looking at selling. And I think we've reached a pretty good point now where we should get some good short trades in place if we find weak companies that are actually trading close to resistance. So the last thing you want to do in this kind of market is chase the price action. And I think it's easy to get caught up in this and to think, well, we're done. We're going to open up businesses in another month, and we're going to come make our way back to highs, so I want to buy now. And that's really not what you want to do. You want to make sure that you are buying at support and you're selling at resistance, and you're treating this as a range-bound to slightly negative market at the moment. Now, that being said, we are in a pretty strong rally, and this could persist a bit longer, but I'd be leery of really trying to chase the price action higher right now. And a matter of fact, my focus this week and my focus over the next couple weeks is probably going to be more focused or more based on earnings movement than it is on market movement. Because again, I think that we're starting to get a little stretched out to the long side. But a lot of the names I like to short are actually still trading close to lows. And so we're going to see how they behave during earnings season, and then I'll move on from there and figure out what I want to do with them. Now, as far as the S&P 500 is concerned and the analysis of it, as far as what levels we could look at, we're actually still holding up over a very critical level. Last week I went over the importance of this level, and I think even the week prior to that. This March March 10th, March 11th, right? This was a critical point in the in our adjustment to the coronavirus pandemic, the COVID-19 pandemic. This was when the NBA shut down the rest of their season, or at least postponed it, and a lot of businesses and a lot of major sports followed suit. And that's what led to a really drastic drop in the markets over the course of the next week or so. We've made our way back above that. And we're actually holding, despite the fact that we've had a couple of selling days this week, Monday and today, we're actually still holding above this, and that's pretty important. If we continue to hold above this, that's actually bullish, and we could look at this as a support level to go ahead and pick up new longs as we make our way up and try to test the 50-day moving average, and maybe even all the way up to 295. Although I think that, again, that's a little high, I think, for what I would expect out of the market. But you never know. If a lot of people are in early short and refuse to give up, then the market could continue to squeeze up to these levels and until we find real substantial sellers. Now, again, personally, I think we're probably going to roll over. But if we can't get back below 273, then I think that's a sign that there's plenty of buyers waiting to step in here, and it's showing support, and it shows that the market wants to move up. Now, on the opposite side of that, once we lose 273, I think that it's kind of a critical turning point where we lose those buyers and that support that they have, and that should lead to a pretty quick drop back into the low 260s and the high 250 area, somewhere around 261 to maybe 255, 254. And then from there we'll see. I think the idea now is we can go ahead and change this trend line, right? So we had this first initial bounce, and I think at this point we could say this is kind of the trajectory we're taking. We'll connect it even with the bottom for now. Now, again, if you look at it like this, that's pretty steep, and we're probably going to lose that soon. So I don't want to put that as the general trajectory of what we're looking for. What I'm looking at is something like this. And as long as we can maintain this kind of trajectory, then I think that's positive, right? So if we come back down to 261, 255, we find buyers and we come back up and test that 273 again, then I think, again, it shows that the market is starting to stabilize and continues to climb upwards. Now, the problem is, if we continue to climb upwards, then that's really just more of a squeeze, right? And what we end up getting is this, we're going to get like a rising wedge, which, as we all know, tends to lead to strong drops eventually, right? So if we continue along this pattern, eventually we're going to have a drop, and it'll be a pretty swift one. So what we're hoping for right now is for the market to flatten out a bit and start trading more sideways and giving us a little bit more back and forth action, which is easier for traders to react to, and it's easier for you to find good entries into trades when you have a market that's going back and forth, because you're constantly testing support and resistance, and it gives you easy benchmarks to look at as far as where you want to enter or where you want to exit your trades. And that's typically the best case scenario for you, is you want a market that is steadily climbing, but doing so in an orderly manner where you could figure out exactly where you want to get in or where you want to get out. Even if you're wrong, it'll give you the right signal to get out, because it'll breach a trend line that you expect to act as support. So that's the pretty critical point for me, is 273. Obviously, to the upside, we've got the 50-pair moving average, which is going to be pretty difficult to get through. And then beyond that, I think if we get back to 295, I think that's very, very strong, and a lot more than I would have expected off of this initial bounce. And we'll see whether we do or not. A lot of times, what happens when you have these moving averages coming down so strong is once you break through one, you come up, test the other, and then you chop kind of in between them, which would mean a retest of the 20-pair moving average at some point in the near future, at which point we can see if it stays stuck in there or whether it turns around and heads back lower. So, like I said, I think for now, we're still in a little bit of murky area here, because there's a lot of earnings reports that are coming out soon, and so I think we're anticipating what's going to happen with those rather than the few that have already come out. So, Wes, you've seen other analysis videos lately about the development of the rising wedge. Any targets on the breakpoint and targets up or down? Okay, so on the videos that you're watching, is it just the rising wedge of the last week? So this rising wedge here, let's zoom in. I think at the moment it's actually still not really a rising wedge. If we're looking at this, we're kind of looking at a rising channel, but it's the same basic idea. Now, what some of them might have done is say, well, it's like this, right? Or more accurately, like this, which would mean that we're starting to break it today, right? So my analysis on this is typically when you have a rising wedge like this, right? You have a drop that it's usually a 2 or 3 day drop, right? And then eventually you come, and it's interesting because we already had this, right? It wasn't really a rising wedge, but let me get rid of this trend line for now. I don't want to confuse people too much, right? And what we're going to do is we're going to use this one. Now, the problem was this one wasn't really a rising wedge because the bottom, the top was basically flat, right? But the same general idea, when you have a rising pattern like this, right, you have a trend line showing bullish sentiment and then it breaks, you tend to have a quick drop, right? And then eventually you'll get a quick retest of that breakdown. And then from there, that's usually where you get the strong move down. Or in this case, we actually are able to just go right past through it and continue climbing upwards, right? So what I'm going to do here is to give you a general idea of more rising wedges. It's really simple. All we got to do is do this, right? So here's a look at the last few rising wedges we've seen in the market. And these were all prior to the coronavirus. Now, again, this is going to be a slightly different environment because this is when the market was very bullish, right? But you'll see you have a rising wedge and then you have a drop. And then the next thing that happens typically is you come up and retest that breakout. And then in this case, we had a strong move, but then we had that second retest of that breakout, right? And then we had another rising wedge, and the same thing happened. You have a drop, and usually these drops tend to be, I don't know, maybe 25-30% of the wedge. And again, we came up, retested, but because the market was so strong, on that retest, we just continued upwards, right? And then we finally had the one real rollover that just continued to come back down, right? So now as we did that again, here was another rising wedge. Well, this was really more of just a pennant, right? And in this case, the market was so weak, it just continued to crater, right? So we've had a few of these patterns, but they all, as you can see, there's not a lot of consistency because a lot of it is based on what kind of environment we're in at the moment, right? So when the market was strong, for the most part, it ignored these rising wedges and would just drop a couple days and come up. Then at this point, the market was crashing, and this really wasn't a rising wedge as much as just a bear flag. We're finally getting what is a rising wedge again. And so my expectation on this is more likely than not, right? It's going to depend on 274, 273. If we break below it, then one or two things are going to happen. One is we get a 1 or 2 day drop and we come up and try to retest it. And then that retest is the real critical area. Do we drop and head back down? Or are we able to do what we just did again and continue to climb upwards? Now, my thought is more likely than not, on that retest, we'll head back down. Now, the difference, of course, is there is a chance that once we lose this 273, we just come all the way back down to this level. But at that point, I consider it the same thing. We're going to come right back up and test this 273, 274 area. And at that point, then it's the same question. Do we head back down and test the 20? Or do we make our way back up to the 50? And I think in this case, if we came all the way down to this 20 and bounced up, there's a good chance that we might be able to overcome this and come back up to the 50. But again, that's predicting something that's at least a week, 2-3 weeks away, right? So I don't want to really judge it that far in the future. Generally speaking, I've noticed with these wedges, a lot depends, of course, on the type of environment you're in. And I think in this case, the fact that we're losing this wedge, if we don't sort of trade above 273, if we head below it, there's a good chance we come back and test the 20. And so that would be my target. On a drop, my target would be down here at around 256. If we were able to maintain this 273 area, then my target would be 287, and then believe it or not, all the way up to 295, as if we would be able to overcome that. And I think that's bold, but I mean, at this point, it's not that far away. And it would just, again, if there's enough buyers here, 273, then I think that shows that they're willing to step up and push it past the 50-day moving average. But for the moment, I expect the 50-day to be a pretty good area of resistance, and I expect us to, at the very least, temporarily break below this before we break above the 50. Now, whether that happens quickly or not, I don't know. But so those are my thoughts, Wes. Like, I don't know if that jibes with what you've seen out of some of the other videos that you're watching, but I think at the moment, more than that rising wedge, really what we're in right now is this right here, which is kind of a rising pennant. But this is basically the same idea as a rising wedge, which is it's a market that's not consolidating in a healthy manner. It's a market that's drifting upwards, showing a lack of selling pressure, and more importantly, buyers chasing the price action, which is basically the same sort of imbalance you'll see in a rising wedge, which eventually what happens is too many people chase it upwards, and those are the ones that are going to lose confidence, and then you get the more quick moves down. And if we do get that move, it should push us back below 273, and like I said, back towards the 20-period moving average. So thank you. That's a good question, and that basically gives us our analysis not only of the S&P 500, but what we are likely to see on the NASDAQ and the Dow Jones. Now, interestingly enough, as we move to the NASDAQ, you'll notice that it's going to be, like we said and what we've covered recently, relatively speaking, strong, right? And you can see again the relative strength. We're above the 50-period moving average. We're making our way back up towards pretty lofty levels. And if we take a look at market leaders like Amazon, they're at new all-time highs. You know, the Amazon trade has been fantastic. I hope that someone in here followed me back when we were looking at it at the 1700 level and the 1800 level. This was a stock that I mentioned at least 3 or 4 weeks in a row on my Patreon page, and it has done fantastic, and it's all the way back up. Another one that we were looking at, of course, is Netflix. Now, again, these are pretty big, obvious trades, but as I mentioned a couple weeks ago, the big, obvious trade is really the easy trade right now. It's the trade you should be doing. You should be looking at going long stuff like Amazon, Netflix, Zoom, which are all stocks that I mentioned on my Patreon page earlier this month as the easy stocks to trade in this sort of economy, right? And conversely, the easy stocks to short are stuff like American Airlines, you know, stuff like Carnival Cruise Lines, and you can see that they're still struggling. They're still trading well below their levels, and will continue to do so. And so this is one of those things. You might tell yourself, well, I missed a move on Amazon. Well, yeah, but it will pull back, and when it does, you know, we're not going to, the environment we're in, this idea of self-isolation, this idea of quarantine, you know, people are still going to be scared to go back to stores once they open. They're still going to shop online. So this is not the kind of trend that changes over the course of a couple weeks or even a month or two. Throughout the rest of the year, we're still going to be dealing with this and with the attitudes that are going to stem from our new situation and our new normal. And these stocks are still going to do well, and some of these others, like airlines, are still going to struggle. So it still behooves you to pay attention to these. But the point I was getting at was these tech names are basically leading the market upwards. And so the Qs, generally speaking, are going to be better. And again, for those that were here last week, I mentioned if you don't want to go into Amazon, you don't want to look at individual names, just go long the NASDAQ when you think the market's going up and go short IWM when it's going short, and you'll do well. And as you can see, the NASDAQ is doing very well, and it's moving upwards even strongly. And this is one of those scenarios, too, where you can see the rising wedge actually broke to the upside. Right? Now, typically, this is not really that bullish. When you have a rising wedge and then you break to the upside, a lot of times that's kind of the signal of like a blow-off top. I don't think that's necessarily the case with the NASDAQ right now, but it is showing a market acceleration in tech names. And again, I think the general public is starting to figure out where the strength is, and they're kind of moving their money there. and away from some of the weaker ones. And we might have an imbalance like that for the foreseeable future, because again, it makes sense. It's not just people's idea of what they perceive to be strong. It is These are the companies that are actually benefiting from us staying at home, and there's no reason to think that they're not going to continue upwards. Now, the one key is, of course, eventually they do get overpriced, and they'll turn around and come back down. But that's when you look at buying them on dips. Now, again, like I said, as far as the Qs are concerned, we've broken above the 50, which is a very critical point to break, because again, we were able to get back above the 20. We were able to get above this March 11th price pretty quickly, and we've even broken back above the 200, which is showing that the Nasdaq is still in a bullish mode. And there's room, a little bit more room to the upside, all the way up to about 217, which is really where the initial drop in the coronavirus scare started here, and really things started to escalate once we headed into March, right? And so that's a pretty critical level to get above. I think this is the line in the sand that I don't think we're ready to break through. And I think generally speaking, what we're seeing today in the last couple of days is going to be probably the temporary ceiling for us as we start to head into more earnings trades or more earnings reports. So there's a decent chance that we top out over the next couple of days around this level or just a little bit above that, and then we head back below the 50 and come back and maybe test the 200 pair moving average. But generally speaking, the Nasdaq is the strongest of the indices, and will continue to be so because most of the names that are benefiting from us staying at home are in the Qs. And while there are weaker names that are holding us from reaching all-time highs, like Amazon and Netflix are doing, for the most part, the strong names are at the very least propping up the tech area and keeping it holding up. And generally speaking, like I said, there's just a bigger percentage of stocks here that are benefiting from people working from home than in any of the other indices. And as long as that continues and persists, then we should expect the Qs to hold up stronger throughout the foreseeable future, at least the next 3, 4, 5 months. So again, if you don't want to look at individual names, you're kind of worried about any stock that might have trouble with an earnings report or bad news, then just look at the Qs in general as a good vehicle to go long. And we'll get into IWM shortly, and you'll see what's a good vehicle to go short, right? Now, the key levels we want to look at, again, I think 217 to 218 is a critical level of resistance. I don't think that we really can push past that. This is basically like the 195 on the S&P 500. It's a level that I think would be very optimistic to be able to push through, because it would basically mean that despite the fact that we've been closed for an entire month now, and probably will be closed for at least another month or two, that the market thinks that we're in the same state that it was back when things were great and when we were trading at all-time highs. And so I don't think that we're ready to price that in, despite the stimulus package that we just got. A lot of the stimulus is going towards keeping employees employed, and not necessarily for these companies to turn a profit or anything. And so I don't think that we're really factoring in just how much trouble there still is in a lot of industries that are going to remain closed, and even when they do open, are going to still have much less traffic than normal because of lingering fears until we are completely 100% free from COVID-19. Now, to the downside, at this point, the 50-pair moving average and the top of this rising wedge is our very short-term level of support. I don't think it means much. I think what's more critical is the meat of this wedge, which is the 200-pair moving average. And then at this point, I expect the Nasdaq to hold above this March 11th, March 12th turnaround and hold above 193. And unless something drastic happens and we get really, really bad earnings reports, I would expect the Nasdaq to hold above these levels and to wait for the 20-pair moving average to come and catch up the price across there. And then from there, we would trade sideways. Now, again, my general belief right now is that we just had a really strong run up, and we're at a point now where we have probably, or are very close to finding where the ceiling is in the short term, and we'll have to come back down and shortly start to test where the buyers are willing to support on the next move down. I don't think that there's that much upside left on the bounce that we've had, And so at this point, we should start to look at where these support levels are. And like I said, I think initially we should find support here at 200, and then more importantly, support around 193 on the Qs. Now, if we lose 193 and we lose a 20, well, then that's pretty, that's a pretty negative development, particularly on the strongest of the four indices, and that likely means a move down to the 180s. But beyond that, possibly even all the way back to lows. So I think on the Qs in particular, we want to see us hold above that March 11th area that I think is important, and kind of stay within this 190 to 210 or so area. Now, next up we have the Dow Jones. Yes, Wes, I'm going to go over it. I'm going to go over Activision actually when we get to the chart requests. That's a good one to add. That is an area that I kind of did not add when I was when I was going over names that I really think are important and I think are going to hold up well during this this kind of self quarantining phase of our economy. I wanted to go over Activision and a couple other video game companies, and I didn't, and I kind of regret that because they've done well. They haven't done. I mean, I think the names that I picked have done better, but that is an area that I wanted to go over, and so we'll go over that one when we get to the chart request. I think that's a good one to look at. I think there's more upside there too. So the Dow Jones. Now the Dow Jones is, relatively speaking, a little bit weaker than well, obviously much weaker than the Qs, but a little bit weaker than the S&P 500 as well. I think some of the industrial names are struggling, and as you can see, we're kind of right back at that March 11th zone. Not that far off from what the S&P 500 is doing. Again, if we go back and take a look where we are, here's that March 11th level. Here's the 50-period moving average, the 200, and so as you can see, the Dow Jones is kind of doing the same thing. Right, just a little bit closer to this, and not really quite as extended to the upside, but the same idea. Right, we've got a rising bull flag, which again is not really that strong. Again, it shows that we're getting a little bit of a squeeze going, and getting a little overbought maybe. Now there is room for us to hold here, and there is room for us to continue upwards. This isn't that extended where it's really that negative yet. And if we continue to kind of push upwards, then again, it will show that the market is stronger than maybe we expect. Now, this again lines up with a pretty critical long-term level on the Dow Jones, which again is the kind of the floor for the price action we saw from 2018 to 2020. Now, again, you might point out, well, we already broke that once, and it really didn't hold that much. But generally speaking, when I make these areas, to me, there's a general perception that a trend line is only good if you connect a lot of dots, right? But the truth is that this is basically a representation of what humans think. So you're not going to have a perfect trend line that just connects every single dot. Generally speaking, I found that to be a pretty good floor when you're just basically examining what kind of range we've spent the last couple of years in. We're going to have moves up beyond it and below it, but generally speaking, the Dow Jones has ranged between, or at least DIA, from 234 to about 264, right? You can see that was a pretty good floor. It was a floor that held for a little bit and then failed back at 2018, 2019. And I think it's the area that we're really struggling to break through now. I suspect that we will not hold this breakout and we'll turn right back around. Again, showing weakness in the Dow Jones compared to what we're seeing on the other two indices. My hope is that the S&P 500 could stay in that range, and the NASDAQ can. And then if the Dow Jones falls below it, it's just a sign of relative weakness rather than the overall markets not being able to get back into that range. And so that's what I'm kind of thinking is going to happen here. I think that we're at pretty critical resistance. And while we are, at the moment, technically above it, we're struggling to hold above it. And there's a pretty decent chance that we come back down. Now, the key here is, if we do come back down, is that we don't roll over back to lows. That we do the same thing that we were hoping happens on the S&P 500, which is we come back and we retest this area around 214, 215. If we break back below the 20, that it's only for a couple days, and then we come right back up, and we just keep chopping back and forth and trading sideways, and trying to stabilize. Like I said, we've had a very strong bounce, and that gives us room to the downside without worrying about coming all the way back down to new lows. And so that's kind of what we're hoping for on the Dow Jones, is if we can't hold above 235, which is probably not going to happen, then hopefully it's just a quick drop, and then we come right back up and test it again and try to get above it once we've seen a couple of weeks of earnings reports out of the way, and it looks like maybe the market has a little bit more confidence on a drop. Because at the moment people are happy because we're going up, and it's human nature to have a recency bias and to think, well, we're up these last few days, and this is what always happens with traders is when the market is up, they want to buy because they see the market strong. Even once it's run up for several days in a row, they think, well, now's when I want to buy because it's strong. And then the patient traders will say, no, I don't want to chase this. I'm going to wait for it to drop. But what happens is then the recency bias kicks on the opposite side of that trade. And once it drops, they get scared and they get nervous about buying because they're like, well, what if this continues to go down? And they worry about buying support, right? And so you want to make sure that you shake that off. And you don't want to chase price action when it starts to get elevated. You want to make sure that you buy it. Now, I'm not saying catch the knife and try to only buy weak names. You want to buy strong names as they come back into support, which is why, for the most part, we focused on those tech names over the last month as names to buy when they come into support, as that's when you get the good risk reward. And so that's what we're looking for here with the Dow Jones, is we want it to come back down and test support, but we don't want it to fall all the way back down to lows. We want it to kind of hold, and then from there see how the bulls turn in and start to buy it again and support it, and then we can maybe start getting that range-bound action that shows that traders have been able to at least maintain enough confidence in the market to not think it's going to continue crashing lower. Now, the one area that definitely doesn't have confidence right now is the small caps and IWM. As you can see, we've already pulled back. So here's a rising wedge that has already failed, right? This was a pretty critical gap to fill. I don't know if Sam, if you're in here, this was the level I told you was a great short in our Discord chat. This area around 124, 125 IWM. One of our members wanted to discuss going short on IWM, and he was looking at buying some puts. And he was thinking about it back here when we were at around 115, 114. I told him a great area would be once we get into this gap. If we get that, that would be a great spot. And as you can see, we're finally starting to drop a bit. I think that that's a very strong level of resistance. Again, relatively speaking, you can see just how weak we are compared to the NASDAQ, compared to the S&P 500, compared to the Dow Jones. Take a look at the weekly and look at where we are compared to where we've spent the last couple of years in. Nowhere near those levels, and this is already, the IWM was already, relatively speaking, weak over the last couple of years. And even now they're continuing to behave in that manner. And like I said before, if you are uncomfortable looking at individual names right now, it makes sense if you think the market's going to roll over, just short IWM, and if you think the market's going to go up, just go long the Qs. And at this point, you could have done both at the same time and you'd be profitable. Now, where can IWM go from here? I think a lot depends on the overall markets. If the overall markets roll over here, then IWM is going to come back down to 111, and more likely than not is going to continue heading even down back into the 106, 103 area. Now, the key with IWM right now is to just not lose this this kind of shallow trend that we've got going, right? We can kind of at least maintain some positive price action. Maybe IWM could get something like this going, right, where we just keep going back and forth and building up against this 124 level and then eventually break past it. And I think that would be a pretty positive development and would be a decent way of behaving as far as the weaker index is concerned. The problem would be if we lose 103, then we're coming all the way back down to 100, and there's a decent chance that because of that, these lows will act as a magnet for aggressive bears and for fearful bulls to just kind of get rid of their holdings, and this will be pushed back to new lows. And if that's a problem, that happens, that's a problem for the overall markets as well, because all of a sudden we have a big section of the market starting to roll right back over. So ideally what we want out of IWM right now is we don't necessarily need it to bounce back up and get back above 125. We just wanted to kind of maintain a steady climb and not to go back towards new lows. I think the levels are much easier for this one. It's really just 124 is the ceiling now, and really the floor that we're hoping holds is around 104. It'd be great if it can hold here around 111, 112, but I don't really have my hopes up that that's going to be a level that really holds. But if it does, then that's fantastic, because that means it held around the 20-pair moving average, and maybe this is an acceleration of bullishness on the small caps, and showing the buyers are willing to step in and take a little bit more risk and are getting a little bit more bold overall with the markets. Not much else I really want to mention with IWM. It's the weakest by far, and it's the one that's not really holding up well. Let's take a quick look at the US dollar, gold, silver. You can see the US dollar still kind of just losing volatility, which is good, and starting to find a range. There's not a lot that you could point out here. It's hard to really gauge just how volatile this is unless if you come back and take a look at how it was before we hit March and the COVID-19 kind of scare, you'll see where the dollar was and what it was doing. Then all of a sudden, you can see just how volatile we got and how all of a sudden the rest of the chart just flattens out because of how volatile these swings have become. Now, the good thing is we're seeing volatility contract again, and we're seeing the dollar start to trade back in the range that it was trading in before all of this started. And that's a good sign. It shows that we're starting to get back into a little bit of normalcy. If you look at the Euro-US dollar cross, which again will be inverse to that last chart we just looked at, you can see volatility contracting. You can see the euro kind of stabilizing in this big triangle as it starts to go back and forth and tries to find a steady range that we could say is a point of equilibrium, and we're kind of right at that spot right now, right around 109.8, almost at 110. There probably is a couple more days of bullishness on the euro before it starts to hit what should be resistance and kind of come back. But overall, you can see it stabilizing. If we look at the U.S. versus the yen, we'll see a similar picture of volatility kind of contracting. We're finding some support here on 107.4. And the key here is for it to not roll right back over, because if it does, then again, volatility will be increasing again. So what we want to see right now is the yen kind of find this as a floor, or the dollar find a floor versus the yen here. And then finally, the last cross we want to look at is the U.S. Canadian, and we'll see strength came back into this because oil dropped again, right? So again, this is an easy one to trade. If you're looking at oil and you see oil starting to drop, well then the U.S. dollar is going to go up against the Canadian. As you can see, oil all the way back down to $20 a barrel. Actually was at 19 earlier today. This is a good floor for those that want to go long oil or think that they like to trade oil. This is not a bad floor for you to go ahead and take a shot at it. There is a chance that we continue that we kind of shake out lower, but generally speaking, this is not a bad place for you to go ahead and try to take another long shot here and just play this range between 6 and 4 on USO. It's hard for oil to get below $20 right now. I think that's a pretty good floor. That's the wrong CL. It could go lower, of course, but I mean that's the case with everything, right? But I think we found what could be a stable floor here. And if that's the case, despite the fact that, again, recency bias will tell you, oh, you don't want to go long now. But if you see a reversal candle in the next day or two, then that gives you a good signal that maybe it's time to go ahead and get long again. And it's maybe doing the opposite of what IWM is doing, right? Where we've got a descending triangle instead of an ascending one. And so that's what we're going to do right now. We're going to look at oil along this context and these lines, and we'll watch it over the next couple of weeks and see if it can maintain this trajectory and behave along these lines, or what else it could do, right? And finally, we have gold and silver, and shockingly, gold finally broke out. I was not ready for this. I did not expect it to be that strong that quickly, but it had a very strong move, and at the moment, it's holding up above what should now be a new floor, which is this 158.50 or so on GLD, right? So we got a big breakout. We finally getting a roll back over. You can see we had a shooting star yesterday, spinning doji today, and depending on how this turns out, this could turn into a bull flag, or it could come back down and retest this breakout zone. And if it does, I expect it to find some support there. Silver, relatively speaking, still much, much weaker than GLD, but it also had a nice move up. Now, and this one actually has what is not that bullish of a pattern as it comes up into some pretty good levels of resistance. So overall, I'm still not excited about silver. I'm still not even really that excited about gold, even though it did have a strong move up. I mean, maybe I should have been looking at it, but I found right now that I have more confidence in the tech names, and so that's where I'm focusing my long plays rather than on something like gold. But I will say I did miss it. I did not expect it to break out, and it did. And I think at this point, we'll see how it comes once it comes back down, but this probably should hold a support. Very, very different pattern here on gold versus silver. And I think if you're invested in precious metals, you probably want to look at gold more than silver, and I think that's been the case for a couple of years now. All right, so that covers the markets, gold, silver, oil. We have a little bit of time for chart requests. We'll go over a couple of ideas here. Wes, you said you're still short IWM. Nice. I'm not. When did you get short? Did you get short over these last few days? I think it's fine. If I would still be short too. I am still short, and like I said, I'm expecting to move back down to at least 111. But not sure when you started the play, but I think overall you're probably in a good place here. It wouldn't have made sense to go short IWM before that. So if you had gone short any of the last 2 or 3 days, then you're in very good shape. If you got short a little early, then you're just back to break even. But I think overall there is more room to the downside. I think overall, speaking just in the general about the markets, like I said, I think that we've reached the point where we need to probably turn back down. I think we've gotten a little, I don't want to say a little too far ahead of ourselves. We needed to kind of recover a lot of that drop. But I think we've reached the point where we should be finding a lot more resistance, and we should probably find buyers getting a little bit more antsy about trying to hold at these levels. All right, so the last thing, you were mentioning Activision, right? So I kind of regret when I looked at the market and I was looking at names to trade as far as the coronavirus situation is concerned, and what names I thought would benefit from it. I ignored the video game developers because I figured, and one other name also, so I'm going to go over some of these video game companies. So Activision is one, just breaking out to new highs, and has done very, very well. Another name that has done well, not quite as well as Activision, but Take-Two has started to climb and is doing something very similar, and they're about to come out with a new game as well. And they're starting to make their way back above the 200 period. So you can see, relatively speaking, they're doing much better than the overall markets, right? Generally speaking, they've recovered a lot of what they lost during this. Basically, if you look at what they've come back up to, they're back up to early February, which means they've overcome the drop that they had before the coronavirus, right? Another name, not quite as strong, but it's GLUU Mobile. It's a mobile game company. And you can see, again, they're making their way back up to the March levels and even February levels that they were trading at, right? So generally speaking, doing pretty well. Now, they are coming up into a pretty important level here, around 750, which is going to be tough to break through. But another video game company that I kind of ignored, and I probably shouldn't have, and they've done very well, particularly off the recovery off of the COVID-induced crash that really, accelerated after March 11th, right? And they've come up basically, if you look at it, from $4 to $6. That's more than a 50% recovery. And this would have been a great one to get into, and I didn't think about it. And the other one I didn't think about that's not a video game company, but I think similar, is Peloton, which is another company that benefits from people staying at home. Now, the reason I didn't trade those was because I didn't consider them as important to us as, say, Amazon or Zoom or Citrix. And I felt Netflix was a little bit more of a play as far as finding something for consumers to do. The reason I kind of didn't really trust these names was because I didn't know that people would still have money to spend, right? Because it's still these companies still benefit mostly from discretionary spending and from people having extra cash to go ahead and buy stuff during these times. And a lot of a lot of names, or sorry, a lot of people don't really have spare cash right now. So I didn't expect Peloton to really continue climbing as high as it did. And the same thing with Activision. I figured a lot of people would be playing video games maybe, but not buying new ones. And I was wrong. And they have continued very strongly. I think they've done well. Obviously, they're going to continue to do well as long as we stay holed up in our homes. And I think at the moment, none of them really present good opportunities because they've already moved up. And so I chalk this up as to I missed the trading opportunity, and I'll just add them and keep an eye on them on my watch list and watch for the next drop and see if I get a good value on them and see if they give me good buying opportunities. But at the moment, none of these really present patterns that I would want to buy at all. But I do think this was some names that I definitely considered, but I didn't go ahead and add into my articles. Because I kind of like the other names better than these, but these are names that I probably should have considered a little bit more closely, because they have provided good trades, and even if I didn't trade them, I probably should have made my thoughts on them more public than I did. But again, there's a lot of names that you ignore during these times that can do well, and you can only pick a few that you really like. But I do like these, and I think that they will continue to hold up well. Alright, so you said you're short IWM, but you're playing TZA for it. Okay. So this is the bearish one. Again, you probably just bought it, right? Because if you had bought it before, then you were early. But I think that's fine. I know I tend to steer people away from these triple leverage funds because they're such a trap. But if I know you're a pretty seasoned trader, and you usually give me good charts that you're looking at when you're trading. So I'm assuming that you are comfortable enough to understand the short-term window that you have for these trades to succeed, right? Because if we don't get an extended drop, then this thing's going to turn right back around, and it's going to be hard for you to get back to break even. But if we do get a good 2 or 3 or 4 day drop, then you're going to get a pretty good move on this. And it's very similar to buying puts, basically. If you don't get the trade to work in your window of time, then you end up losing the value on it. And that's kind of the same case here. Is you'll have a certain amount of time for this to work, and if it doesn't, then you just kind of have to cut the cord, because you'll know sooner or later this will decay. Interestingly enough, when I was this is a discussion I had in the Discord chat. When gold did well, if you look at GDXJ, right, the gold miners, you can see what a nice recovery the gold miners have made, going from basically 20 all the way back up to $40, right? Which is pretty impressive. However, if you take a look at the triple leverage gold miner, junior gold miners, J Nugget, you'll see what happens with these things when they really accelerate. You can't make up that kind of ground, right? Now, granted, it did basically go up from $4 to $7, so it did have a decent recovery. But if you look at it, if you had bought this, the longer you hold this, the more chances this is not going to work in your favor, right? And I can't remember the name of the inverse of this one. What was this one? Okay, so JDST. So you'd think, well, okay, so maybe the inverse would have done well, right? But if you look at the inverse, it's the same thing. It never really made up on that drop, and then it never kind of made it back up. And so, it had the big move, and then it just dropped. And so these names, in the long run, they just don't work, right? And again, I know that you're you're a more experienced trader, and I expect you to hold TZA for a short amount of time. Um, but just pointing out again, these things, the longer you hold them, the more often they don't work in your favor. And again, all I have to do is go to the weekly chart of TZA, and you can see what happens over the long run with this, or monthly chart. And you can see that they just continue to reverse split because it always decays, right? So, keep that in mind. Again, if we get a 2 or 3 day move up or move down on IWM and this thing runs up, then you got yourself a really good trade. But just don't get greedy with it. All right, so I think that covers it for today. If anyone else in here or anyone watching this video later, again, like I said, if you have a chart request, if you're watching this as a recording and you want me to look at a chart for you, feel free to message me on Twitter or find me on our Discord chat, and I'd be more than happy to go over that chart for you. So, Wes, do I think the jump in Amazon, Walmart, DG have anything to do with stimulus checks going out this week? That is a good question. I don't think so. I think it's just generally speaking, people have realized that those companies are doing. Amazon, I think one of the big things with Amazon is that Amazon actually started hiring more people. Let me see if it's one of the articles here. No, it's not on here now, but Amazon actually, they were doing so well that they actually had to hire more people. And I think that was a big part for the big jump. But I think it's just more and more people are realizing that these companies are not losing business, right? If anything, they're gaining business. And so I think that's why they're doing well. Now, you could be right. I didn't think about that. Maybe the stimulus has a little bit to do with it. But I don't know that that's necessarily the case. Walmart was doing well, but even before, I think it's just that people have realized these companies have not been hit. So, if you go back a few weeks ago to what we were discussing, and I discussed this for sure earlier in March. There were going to be names that were going to be unfairly hit during the market drop, right? So when the market drops, everything falls, right? It's just the way it works. And there were going to be names that were going to be unfairly hit with this and were going to be basically collateral damage. And if you look at Amazon's business model, they were, if anything, going to do better. Now, of course, you're going to have an economic slowdown. You're going to have some people are going to be spending less money, but still more of their spending was going to be funneled through Amazon than what normally was. And the same thing, most of the money that people have left, they're using it basically for either for groceries or for day-to-day supplies, as they use more because they're staying at home, right? So I think that these companies were names that were hit harder than they probably should have been in the market, and because of that have kind of recovered more quickly. Now, it makes sense to say, well, yeah, stimulus checks are going to cause Amazon or Netflix to go up, but the truth is that doesn't really make sense.